Hello and good morning friends, welcome to the CEC-UGC live lecture. Dear friends, with our ongoing series on financial accounting, today we would be talking on financial statement. This is the second lecture on adjustments, and today also we are going to get maximum knowledge on the topic, and I would say that this is the 16th lecture in the series. So dear friends, we would like to tell you all that for this very discussion we have once again with us in our studios Mr. MC Sharma. Mr. MC Sharma is Associate Professor in Department of Commerce, Shahid Bhagat Singh Evening College, University of Delhi. So let's welcome our guest Mr. MC Sharma, and let's try to understand more and more about the topic, that is financial statements, basically adjustments. Hello sir, welcome to the UGC lecture.
Thank you. Dear friends, in our first part of financial accounting adjustments, we have already discussed the adjustments relating to closing stock, outstanding expenses, prepaid expenses, accrued income, unearned income, depreciation, bad debts, provision for bad debts and doubtful debts, and provision for discount on debtors. In the current lecture, we are continuing the remaining adjustments. So today we shall discuss the adjustment relating to provision for discount on creditors, interest on capital, interest on drawings, interest on loan borrowed, then some important adjustments of the relating to the goods, and some errors, omissions, loss of goods and loss of fixed assets by fire, theft, accident, commission payable to manager, and also adjustment relating to writing of deferred revenue expenditure, and some errors and omissions, and any other some important adjustments. So we are starting from the first one, that is provision for discount on creditors. As we know that the creditors is a liability for the firm, and when we make payment, prompt payment to them, then they may allow the discount to us. So as we make this provision for discount to be allowed on debtors, so similarly some accounting people argue that we should also make a provision for discount to be received on creditors. Although we know that this adjustment is not supported by prudence principle. According to prudence principle, the possible income should not be recognized, but possible losses should be recognized. But as we see in the books, this is given. So how, if it is given for a student, as a student, then how should you treat it? So if it is given, we have to treat according to the accounting rules, and then it depends upon the past experience of the firm, that on an average basis how much discount they can receive on their creditors. So the discount to be received will be income for the firm, so it is to be credited, and we pass the adjustment entry for provision for discount on creditors is provision for discount on creditors account debit to profit and loss account. Now how this should be shown in the final accounts? As it is an income, so it is shown on the credit side of the profit and loss account, and it is deducted from creditors on the liability side of the balance sheet. When we calculate the net amount to be credited to profit and loss account, and already some provision for discount on creditors is given in the trial balance, then we can apply a equation given here, that is the discount received plus provision to be maintained minus provision given in the trial balance. So it will calculate the net amount to be credited to profit and loss account. We may understand this also with an example. In this example, we are given creditors 80,000 and provision for discount on creditors given 4,000, and discount received during the year is given 4,500, and adjustment is given, make a provision for discount on creditors at 3%. So we have to calculate the amount to be credited to profit and loss account. So that is the discount received at 4,500, and then the provision to be maintained is 3% on creditor, that is 3% on 80,000. So it is a 2,400, minus 4,000, the already provision given in trial balance or the opening balance. So net gain to the firm will be, expected gain will be 2,900 only. So we will show it in the profit and loss account like this. On the credit side, by provision, by discount received 4,500, add new provision for discount on creditors 2,400 and less existing provision 4,000. So the net balance 2,900 will be shown on the credit side of profit and loss account. In the balance sheet, on liability side, creditors are given 80,000 and we will deduct the provision for discount to be received, that is to be carried forward, that 2,400, and the balance 77,600 will be shown net amount column. Now we will discuss the interest on capital. We know that the capital is the amount which is provided by the owner to the firm or business to run the business. So in many cases the interest may be charged by the owner because he has invested his money. So the interest on capital may be given an adjustment. So if interest is to be provided on capital, so it is a loss to the firm, and being loss it is to be debited. So entry will be interest on capital account debit to capital account. How it will be shown in the final accounts? As it is a loss to the firm, it will be shown on the debit side of profit and loss account, and it is a gain to the owner, and so it will be added to the capital on the liability side of the balance sheet. As we allow discount on, as we allow interest on capital, so similarly when the owner makes the drawings, it may also be decided that the interest should be charged from the owners or from the partners on drawings. So when interest is charged on the drawings, it is a gain to the firm. So when we pass the entry, it will be gain to the firm. So entry will be capital account debit. In case of the partnership, partners capital account debit to interest on drawings account. So interest on drawings account is the gain to the firm, so it has been credited. How we will show it in the profit and loss account on final accounts? It is an income, so it will be shown on the credit side of profit and loss account, and it is to be charged from the owner, so it will be deducted from the capital on the liability side of the balance sheet. If a firm has borrowed some loan, some money from the others, so we know that the on loan interest is payable, but sometimes interest has not been paid for the full year. Although we have already studied one adjustment, outstanding expenses. So it is like the outstanding interest on loan, if the interest has not been paid for the full year. So interest on loan is an expense, so we have to debit it. So interest on loan account debits to outstanding interest account. So outstanding interest is the interest due but not paid for the current year. How it will be treated in final accounts? It is a expense, so it will be shown on the debit side of profit and loss account. If there already interest on loan is given, so we will add this outstanding interest to the interest on loan. And in the balance sheet on liability side, it is a liability, we have not paid the interest, so it will be shown on the liability side of the balance sheet. In case of this interest on loan borrowed, sometimes there may be implied or hidden adjustments. What is this hidden adjustment or implied adjustments? If a loan account carrying certain rate of interest is given on the credit side of the trial balance, so it is essential to calculate the interest with on the whole amount, and we have to check whether full interest has been paid for on the loan or not. If interest paid is less than the interest for the full year, it means the difference is payable by the firm. So it is the adjustment which is to be made, although not mentioned in the question clearly. we can see all these three adjustments with the help of this an example. In this example, we have given information loan at 15% per annum, that is 1 lakh is given on the credit side. Then interest on loan 9,000, it means this is the interest which has been paid by the firm on loan. Capital is given 60,000 on the credit side and drawings is given 12,000 on the debit side. Here only two adjustments are given: allow interest on capital at 12% and charge interest on drawings at 8%. So what we see here, the loan is given at with a certain rate of interest, that is 15% per annum. It means it is our duty to calculate the interest. So on it nothing is given, it means this loan was outstanding for the full year. So loan is the 1 lakh and rate of interest is 15%. So the interest for the whole year becomes 15,000, while the interest paid on loan is given only the 6,000. So therefore we could check it that the interest paid 9,000 while the interest for the whole year 15,000. So outstanding interest on loan is rupees 6,000. So we have to make adjustment for this also. Now you will see how it will be shown in the profit and loss account. Interest on loan being expense on the debit side. So to interest on loans 9,000 which has been given in trial balance and already paid. Then outstanding interest on loan 6,000 which we have calculated. So we will add this outstanding interest and the total amount 15,000 will be shown on the debit side amount column. Then interest on capital. Interest on capital rate is given 12% and the total capital is given 60,000. So at the rate of 12%, the interest on capital for the whole year is 7,200. As it is an expense, so we will show it on the debit side of profit and loss account to interest on capital 7,200. Then we are given another adjustment relating to interest on drawings. Drawings are given 12,000 and rate of interest 8%. So normally when per annum and other information not given, then we charge the interest for the whole year. Normally it is the average rate of interest. So at the rate of 8% on 12,000, the interest becomes 960 rupees. It is a gain to the firm. So it will be shown on the credit side of profit and loss account. So by interest on drawings 960. So all these three adjustments will be presented in this manner in the profit and loss account. Now we will see it how they will be shown in the balance sheet. In balance sheet, we are showing the capital 60,000 given, less drawings because drawings are deducted from capital. So less drawings. Then interest on capital allowed is to be added to the capital. So add interest on capital 7,200. And interest on drawings is to be deducted, so less interest on drawings. So after putting all these three items, we find 54,240 the net balance. And in case the complete question, the net profit or net loss will also be shown in this item. Net profit shall be added to capital and net loss will be deducted. Then another item is the loan. Loan is a liability, so loan is 1 lakh given. Then outstanding interest we have calculated 6,000. So as we know that the interest on outstanding is added to the loan. So we have added here the outstanding interest rupees 6,000. So the total balance 1,06,000 is shown in the balance sheet. Now we shall discuss some adjustments relating to goods. The first item is the loss of goods by fire, theft or accident. It is sometimes in the business that some goods from the shop or from the godown may be stolen. There may be some accident, goods may be damaged. There may be an event of fire and some goods may be destroyed by fire. So in any case, it is a loss of goods. So we have to calculate the value of the goods lost, and this value is always calculated at cost price. So we will calculate the gross loss of goods. Normally in final account question it is already given, and so it being the loss, abnormal loss of goods account shall be debited. We could also specify it clearly that loss of goods by fire, or loss of goods by theft, or loss of goods by accident. And to purchases account or trading account. Why we are crediting the purchases account? We are crediting the purchases account because the goods purchased for the purpose of resale has been reduced. So we are crediting the purchases account. Or alternatively, we could also show it on the credit side of trading account. Because the goods purchased for the purpose of resale has been shown on the debit side, so the goods which is not available for resale can be shall be credited. So it will reduce the cost of goods available for resale. So any method we could adopt, in both cases it is true. As we know that normally the firms may get the insurance of the goods or insurance of the shop or go down. So if the goods was insured, and then the insurance claim is filed with the insurance company, and after the survey by the surveyors of the insurance company, the insurance company will inform that how much insurance claim has been accepted by the company. So if the insurance claim accepted by the company has been given, then we will pass the entry insurance claim account debit to abnormal loss of goods account. Insurance claim account debit because this is now an asset, the amount receivable from insurance company, and the loss has been reduced. So the abnormal loss of goods account has been credited. Then there is a difference between the two, the gross loss shown in the first entry and the insurance claim accepted in the second entry. So the difference between these two is the net loss of goods. So that loss of goods is of abnormal nature, not of the trading nature. So it will be shown on the debit side of profit and loss account. And we will pass the entry profit and loss account debit to abnormal loss of goods. And in this way, this account, new account opened, abnormal loss of goods account, that shall be closed. And we could also pass a direct entry for all these three entries. After calculating this cost of goods lost or gross loss, insurance claim accepted and net loss, we could pass entry insurance claim account debit, profit and loss account debit, that is the net loss, to purchases account or trading account. And how will show directly in the financial statements or final accounts? The cost of goods lost or destroyed, because this goods is not available, so it will be deducted from purchases, or it will be shown on the credit side of trading account, whatever the entry we have passed. Then net loss, that is the difference between the gross loss and insurance claim accepted, that is the abnormal nature loss, so it will be shown on the debit side of profit and loss account. Insurance claim accepted by the insurance company being an asset or the amount receivable, that will be shown on the asset side of the balance sheet. Normally it is shown in the current assets because the amount will be received within a year. Now the next is goods withdrawn by proprietor for personal use. It may be a practice, it may happen in the business that the sum of the goods is withdrawn by the owner from the firm for its personal or domestic use. So this goods is not available for the purpose of resale, so that goods is reduced, and it is the amount withdrawn by the proprietor, this either in cash or kind, so it is known as the drawings. So entry will be drawings account debit to purchases account. How will show in final accounts? First it will be deducted from purchases on the debit side of trading account, and then it will be deducted from the capital on the liability side of the balance sheet, as we know that the drawings are deducted from capital. goods may also be given as charity in the business, and we know that the many times there is some social organization or social event, just like if you have a provisional store and in a market and they are going to organize some religious event, so they may come for some donation with you and you may give the goods as a charity or as a donation. So in that case, the charity account debit, charity is also an expense for the business, so the charity account debit to purchases account, because the goods for resale has been reduced. How will we show in the final accounts? We will show that the goods is not available for resale, so we shall reduce from the purchases, deduct from the purchases, we will show less goods given as charity on the debit side of trading account. And then being it a loss of the non-trading nature, so we will show it on the debit side of profit and loss account. In business, it is also a common practice to give some goods as a sample, free samples distributed to some potential customers or some of the customers. So this is also the goods are not available for the purpose of resale, and this free samples is like an advertisement. So if this information or adjustment is given in the question that the goods worth rupees suppose 2000 has been distributed as free samples, then we will pass the entry for this free samples account debit or advertising account debit to purchases account. And how we will show it in the final accounts or financial statements? In final accounts, the cost of goods given as the free sample is deducted from purchases in the trading account, because this goods is not available for the purpose of resale, and being expense or the loss, it will be shown on the debit side of profit and loss account, because it is the expense for the firm. So these are the adjustments relating to goods. Another use of the goods is there. Sometimes the goods may be used in the business to manufacture or construct a fixed asset. For example, a trader dealing in iron and steel can use the saria or the for in construction of the building. So in that case, if this goods is not available for the purpose of resale, it has been converted into the fixed asset. So we will pass the entry fixed asset account debit, in this case example building account debit, to purchases account. Similar example is for that the timber merchant. A timber merchant dealing in the timber, and that timber can be used to make the office furniture or furniture for the as a fixed asset. So in that case again the furniture account shall be debited and purchases account shall be credited, because that much goods is not available for the purpose of resale. So we see that the goods can be used in construction of the fixed assets. So we have to make adjustment, because that goods is not available for the purpose of resale. If we do not show this adjustment, then our gross profit will not be correct. How it will be shown in the financial statements? The cost of goods used in construction of the building is deducted from the purchases in the trading account, and the cost of goods will be added to the fixed asset. In the present case, it will be added to the building in the balance sheet. Another precaution is to be taken in this case, that if we are charging the depreciation on the fixed asset, then we should charge the depreciation on the new value of the fixed asset. So in any question, any adjustment is given which is changing the value of the fixed asset, then before calculating or charging the depreciation, we have to consider that also. So there are certain adjustments which may have the side effects on other adjustments. So first we should check it that how the value will be changed and how it will affect the other adjustment also. So we have discussed some adjustments relating to the goods, and sometimes these goods can be sold on sale or return basis. Suppose you ask your customers that okay, you take away the goods, if you don't like you can return it within 2-3 days. In that case, if the sale is not confirmed on the last day of the financial year, then we have to make adjustment, because it is not the actual sale, and according to the revenue recognition accounting principle, the firm has not acquired the actionable claim against the sale of goods, so this revenue cannot be recognized. Normally in practice what happens, when goods is delivered, goods is given, it is considered as a sale. So we have to reverse that entry, sales account debit to debtors account at the sale price. When it is not a sale, it means the cost of goods will be basically our stock. So we have to make adjustment in closing stock. We will add the cost of such goods with the stock, and it will be added in the credit side of the trading account, and it will also be shown in the balance sheet on the closing stock, the stock with customers. So this adjustment have the 3 places, one in the sale, another is the debtors also, then in closing stock and trading account as well as in the balance sheet. So debtors are affected, again we have to keep in mind while making a provision for bad debts or the discount on debtors. So these adjustments we discussed with relating to goods and interest on capital drawings and this interest on loan. Hello friends, so we are continuing the remaining adjustments relating to financial statements. As we discussed the loss of goods by fire, theft and accident, so the similar event may happen relating to fixed asset also. Like the furniture may be damaged in some accident, furniture may be destroyed by fire, furniture may be stolen. So the similar thing may also happen with the fixed assets. So in case any adjustment is given relating to the loss of fixed asset, then we have to make adjustment for that also. So in that case again the fixed assets may be insured. So we should the insurance claim may also be given, insurance claim accepted. So we will pass the entry, this entry we are showing direct entry, that the insurance claim account debit, the claim accepted, then the net loss, that is the loss of fixed asset at cost minus claim accepted, that is profit and loss account debit by the net loss on account of fixed asset and to fixed asset account. So how we will show it in the financial statement? The net loss of fixed asset being abnormal loss will be shown on the debit side of profit and loss account. Insurance claim accepted is an asset, so it will be shown on the asset side of balance sheet under the current assets, other current assets. Then the value of the fixed assets destroyed is deducted from the respective asset on the asset side of the balance sheet. We could see this with the help of an example. Like the information given in trial balance at the end of the year is furniture rupees 50,000, and adjustment is given. Furniture having a book value at the beginning of the year of rupees 10,000 was destroyed by fire on the last week of March, and insurance company has accepted a claim of rupees 3,400. Another point is given, the company charges depreciation on furniture at 10% on written down value method. So in this case, first of all we need to find out the book value of the furniture which has been destroyed by fire. So the fire occurred in the last week of the March, so we will charge the depreciation for full year. So the gross loss is 10,000 minus 1,000, that is opening balance of furniture destroyed minus 1,000 depreciation on that part for full year. So 9,000 is the gross loss, and it will be deducted from furniture on the asset side of balance sheet. Then net loss of fixed asset, that is 5,400, 9,000 gross loss minus 3,400 insurance claim accepted by the insurance company. So it will be shown on the debit side of profit and loss account. Insurance claim accepted, that is rupees 3,400, the claim to be received will be shown on the asset side of the balance sheet in current assets. So what we could relate this adjustment with the loss of goods. In case of loss of goods, the gross loss of goods was to be deducted from purchases, while in case of the loss of fixed asset, the gross loss is to be deducted from the fixed assets. Other items are the same. Insurance claim accepted will be shown in both the cases in the current assets in balance sheet, and the net loss being abnormal loss which shall be debited to the debit side of the profit and loss account. So in accounting, if you could relate the similar nature of transactions, you could easily understand what should be the accurate or actual treatment of the different adjustments. It simplifies the process of understanding the accounting. Now we shall discuss one adjustments which is also some common practice in business, the manager's commission payable on profits. Sometimes when the managers are appointed, they may be given a fixed salary, and to motivate them, the firm may offer a commission to them. Okay, if you earn more profit, so whatever the profit you will earn, you will get some commission. And so how the commission shall be calculated and how it will be treated in the financial statements. It depends upon the language of the terms between the firm and the manager. So there may be the two types of the terms. The first term is when commission is payable on net profit before charging such commission. So in this case, first we shall calculate the net profit before commission and then apply the rate of commission and can calculate commission equal to net profit before commission into rate over 100. But sometimes the language may be a little different from the first one. It may be when commission is payable on net profit after charging such commission. So this language after charging such commission, so how can we calculate the commission if the commission is not known? So how can we find out the net profit after commission? So we know that the net profit before commission is available. So in that case the formula is to be modified. The commission shall be equal to net profit before commission into rate over 100 plus rate. It is this formula has been derived from the basic mathematical method. Just for example, if the net profit after commission is rupees 100, then what will be the commission? will be easy to calculate that the net profit after commission is already, we have assumed 100. So, the commission will be rate over 100. So, what will be the profit before commission? That will be 100 plus commission. So, on that basis this formula has been derived, because we know that we have the figure available is net profit before commission. And what entry should be passed? It is an expense for the firm. When it is an expense for the firm, it will be debited to the profit and loss account. So, the entry will be profit and loss account debit to commission payable. And in final accounts, this commission being expense will be shown on the debit side of profit and loss account. And the commission has not been paid, it is payable because we calculate at the end of the year, and so this will be shown as a liability in the balance sheet. But sometimes there may be given the advance paid against commission to the manager. So, on the liability side, the advance shall be deducted, so we could show the net liability on account of the commission payable. To understand this adjustment, we would like to take an example. If firm's net profit before charging manager's commission is given rupees 55,000, and we have to calculate manager's commission. So, calculate the manager's commission and net profit if rate of commission is, first case 10% on net profit before charging such commission, and in second case the 10% on net profit after charging such commission. So, in case of the first language, 10% on net profit before charging such commission, net profit before commission is already available 55,000. So, we can calculate this net profit before commission into rate over 100, as formula already told to you. The commission is equal to 55,000 net profit before commission into 10 over 100. So, the commission payable to manager will be 5,500. It will be shown on the debit side of profit and loss account, and the net profit after commission in that case will be 55,000 minus 5,500, 49,500. But if the language is the second one, the commission is payable on net profit before charging such commission. So, it will be the after charging such commission. So, net profit before charging such commission is given, and so we have to calculate the net profit after charging such commission. There is the typing error on the screen. So, the commission will be equal to net profit before commission into rate over 100 plus rate. So, the commission will be 55,000 into 10 over 100 plus 10, it will be 100 plus 10, typing error is there again. So, we will find out the 5,000, the net commission payable. So, we will show this commission payable to manager on the debit side of profit and loss account 5,000, and in the second case the net profit after commission will be 50,000. So, in this adjustments we have to take care about the language. There is one term, deferred revenue expenditure. We have already discussed three types of expenditures: revenue expenditure, capital expenditure, and deferred revenue expenditure. Capital expenditure, the expenditure which creates an asset and benefit the firm for more than 1 year, that is for the long term. For example, the purchase of building, land, plant, machinery, furniture, motor vehicles, any other. Then there is the revenue expenditures. Revenue expenditures are those expenditures which do not create any capital value or capital asset, and their benefits are derived immediately. For example, wages paid, salaries paid, electricity bill paid, telephone charges paid, stationery consumed, conveyance charges paid, all these are the revenue expenditures. There is another category of expenditure, that is deferred revenue expenditure. Deferred revenue expenditures are those expenditures which are of revenue nature, but their benefits are derived for more than 1 year. For example, say a product advertisement expenditure on launching a product. So, the heavy expenditure may be made on advertisement on launching a new product by the firm, and this expenditure will benefit the firm for more than 1 year. So, in that case, this expenditure shall be categorized as deferred revenue expenditure. So, according to matching concept, the whole of such expenditure cannot be charged to profit and loss account because the benefit is derived more than 1 year. So, this should be charged to the profit and loss account over the period of benefit. So, an appropriate amount of this expenditure should be written off by debiting to profit and loss account. We can have an example. Rupees 30,000 have been spent by a firm on advertising campaign to launch a new product, and it is estimated that its benefit will last for 3 years. So, only the 1/3 of this expenditure, rupees 30,000, should be written off every year, and the balance amount will be shown on the asset side of the balance sheet. It is normally that miscellaneous expenditure, or it is an item of the accumulated loss or fictitious assets, we call it. So, what will be the adjustment entry? Because the benefit will be derived for 3 years, only 1/3 of it shall be debited to profit and loss account. Profit and loss account debit rupees 10,000 to deferred advertisement expenditure account 10,000. So, in that way, the balance of the deferred advertisement expense account shall be reduced by 10,000. So, it will remain the 20,000. So, in profit and loss account, 10,000 will be shown on the debit side of profit and loss account. That will be the deferred advertisement expenditure written off, and the unwritten off amount, that is 20,000, will be shown on the asset side of the balance sheet. It is normally in the heading miscellaneous expenditure heading or fictitious asset, and so 20,000, that is the 30,000 minus 10,000, it will be shown on the balance sheet side. We know that the errors and omission, it is very common practice, and sometimes some transaction may be omitted to be recorded in the business, or some error may happen there. We have studied the different type of errors, like the errors of principle, that is a revenue expenditure treated as capital expenditure by mistake or error, or an capital expenditure treated in the books as revenue expenditure. Sometimes the sales may be recorded in purchase book, or purchase may be recorded in the sales book. So, any errors may be there. And if there is any error, then they will be rectified as soon as we know, and as we have known it before preparing the financial statements, so we must rectify, and rules of rectification shall be applied. Basic rules of rectification are that wrong debit are to be credited and wrong credit are to be debited. If any debit item has been wrongly credited, then it will be debited twice by the double amount. So, we can have a few examples. One example we are taking here: goods sold and dispatched but omitted to be recorded. So, it is basically omission. The goods has been sold by the firm, has been dispatched to the customer, but has not been recorded. The bill has not been either issued or bill has not been recorded. So, it is a simple omission that the sale of goods has not been recorded. So, we will pass the entry to record the sale of such goods. So, sale is recorded debtors account debit by the individual name to sales account. If we are making direct adjustment, so it will be added to the sales in the trading account on the credit side, and it will also be added to the debtors on the asset side of balance sheet. And this adjustment also has a side effect on the debtors amount. So, that is, if any adjustment is to be made for a provision for bad and doubtful debts or provision for discount on debtors, then that amount will also be affected, because any other adjustment should be done only after rectifying the basic corrections in debtors and creditors. So, this is an error, and similarly goods purchased included into stock but omitted to be recorded. Sometimes it may happen that you have purchased the goods has been reduced, you got a challan, but you have not received the bill from the supplier. Normally goods is recorded in accounting books when you receive the bill. So, the bill has not been received, or bill has been received, but the accounting people has forgotten to record it. So, they came to know before preparing the financial statement. So, what we are finding that in this case the goods has been purchased by the firm, already included in the stock, but has not been recorded. And so, we have to pass an entry to record the purchase of goods, that will be purchases account debit to creditors account. Individual account shall be credited, and in financial statement purchase will be increased. So, this amount should be added to the purchases on the debit side of trading account. And in balance sheet the creditors amount should be increased. So, we have to added this amount to the creditors. Again, we have to keep in mind that if there any adjustment has been given for the provision for discount on creditors, then such amount should also be considered. It means that provision for discount on creditors shall be calculated after making this current adjustments. Another example of errors and omissions, that capital expenditure wrongly treated as revenue expenditure. So, in this case deduct the amount from revenue expenditure in trading account or profit and loss account and add to the respective asset on the asset side of balance sheet. As it is affecting the asset value, so we should also keep in mind while calculating this depreciation. We would like to have some example that capital expenditure wrongly treated as a revenue expenditure. Information given is machinery and equipment 72,000 and repairs are given debit side 15,000. Repairs is a revenue nature expenditure spent on the annual maintenance of the machinery, and machinery and equipment is the fixed asset. The adjustment given in the question is an equipment purchased for rupees 8,000 has been debited to repairs account. So, it is an error. So, we have to rectify it. Another adjustment has been given, charge depreciation at 10% on machinery and equipments. So, first we need to rectify the first adjustment, that is the wrong treatment of capital expenditure as revenue expenditure. So, in this case rupees 8,000 shall be added to the machinery and equipment in the balance sheet asset side. So, that amount will become 80,000, because 72,000 is opening balance, 8,000 the purchase of equipment shall be added 80,000, and then we shall charge the depreciation at the 10%. So, the depreciation charged will be 8,000 and not 7,200, that is the on balance given in the trial balance. While in the profit and loss account, the repairs rupees 15,000 on the debit side we show in profit and loss account, but this amount to be rectified shall be deducted, that less the purchase of equipment which has been capitalized. So, 8,000 shall be deducted and only rupees 7,000, the remaining balance of repairs, will be shown on the debit side of profit and loss account. Another example where the revenue expenditure has been wrongly treated as capital expenditure. It is the reverse of the previous example. So, when a revenue expenditure like wages or repairs and maintenance, any other, they may be by mistake or by error may be debited to asset, that is treated as capital expenditure. So, in this case that amount which has been wrongly treated as capital expenditure shall be deducted from the asset and it will be shown on the debit side of the profit and loss account or the debit side of the trading account, as the case may be. Like in case of the wages, it will be shown on the debit side of the trading account, and if it is the salaries or any other expenditure, that will be shown on the debit side of profit and loss account. So here we take an example. The building value of building given in trial balance is 82,000 and the wages are given 15,000 debit. They say the wages rupees 3,000 paid for construction of building has been debited to wages account. So according to the principles of accounting, the wages for construction of building is an capital expenditure. So it will be debited to profit and loss account, trading account. It will be debited added to the building account, capital expenditure. So in this case it is the error. So what we have to do, the wages of rupees 3,000 which has to be debited the building account. So we have to make correction or adjustment that 3,000 wages that will be deducted, that will be added to the building and deducted from the wages 15,000. So when we show in the financial statements, trading account debit side, we will show wages 15,000 less wages paid for construction of building. So the net wages rupees 12,000 will be shown. And while in case of the balance sheet, the building account asset side 82,000, then we will add wages paid for construction of building 3,000 and the balance of the building account will be 85,000. So if any depreciation is to be charged on the building, then the depreciation will be charged on 85,000 and not on this 82,000. So that is the errors and omissions. Another error we can take as example, the remuneration paid to an employee which was debited to his personal account. Remuneration that may be, suppose the salary is to be debited to the salaries account, not the personal account of the employees. So if this is an error, it is to be rectified, and example we could see the salaries account balance has been given 12,000. Mr. X, the debit balance given 2,000. So now it is mentioned that the salaries paid to Mr. X has been debited to his personal account. So it is the rectification rules that wrong debit is to be credited. So Mr. X's account shall be credited and the salary being expense shall be debited. So the entry will be salaries account debit to Mr. X, and when we show directly in the financial statements, the profit and loss account debit side, salaries will be 12,000 plus salaries paid to X wrongly debited to X's account 2,000, and the Mr. X balance will be nil. It will not be shown in the balance sheet because the balance in Mr. X's account will be nil. There may be any other adjustments. We have to apply the basic rules of debit and credit. For example, a person who is our customer as well as supplier. So as a customer, his balance may be shown in the debtors list, while as a supplier, his account may also appear in the creditor. But when we settle the accounts, there will be either he will be a net debtor or he will be a creditor. So how to rectify that? That lower of the two balances shall be deducted from debtors as well as from creditors. So any amount of the debtors and creditors will be changed, and any adjustments relating to debtors or creditors has to be modified accordingly. Just for example, debtors are given 29,000 and creditors 14,800 in trial balance. Mr. Harish is included in debtors for rupees 3,000 and also in creditors for rupees 2,000. So lower of the two is the rupees 2,000. So this 2,000 rupees shall be deducted because as per accounting rules, Mr. Harish is a net debtor of rupees 1,000 only. So as a creditor, his account rupees 2,000 shall be automatically closed by transferring to his debtor account. So deduct rupees 2,000 lower of the two from the debtors as well as from the creditors. So in the balance sheet, the debtors balance will be 27,000 and creditors balance will be 12,800, and any adjustments relating to provision for bad debt shall be made on 27,000 on debtors. So thus we have discussed the many possible adjustments, but even if there is any other adjustments, so simply we have to apply the basic rules of debit and credit or basic rules of the errors and omission rectifications. So that will make the purpose. While making adjustment, we have to keep in mind the accounting principles like the treatment of revenue expenditure, deferred revenue expenditure and capital expenditure. So all these adjustments are nothing but some errors or omissions or some amount left, and rectifying them is important for the purpose of calculating the true and fair profit and true and fair financial position of the firm. So thanks friend.
With this note, thank you sir, thank you so very much. And dear friends, if you want to give your feedback for this particular lecture, then you can mail us at info.cc@nic.in. We would be meeting again very soon and would be discussing on another topic under the series Financial Accounting. Till then, take care, goodbye. Thank you sir, thank you so very much.